How banks keep you poor. Let me ask you something. When was the last time your bank did something that genuinely benefited you? Not a promotion, not a cashback offer with 17 pages of fine print, not a free checking account that stopped being free 6 months after you opened it. I mean something that actually made your financial life better. Take a moment, think about it. Because I have been studying how banks operate for a long time, and the more I learned, the more uncomfortable I became. Not because banks are evil, but because the way they make money is almost perfectly designed to keep you from building any. And the most unsettling part? You agreed to all of it. You signed the paperwork, you accepted the terms, and you probably never read a single page. Today, I am going to show you exactly how that system works, how banks extract money from the people who can least afford to lose it, how the products marketed to you as tools for financial growth are often the exact opposite, and what the people who actually understand the system do differently. And I promise you, by the end of this video, you are never going to look at your bank account the same way again. Section 1. The business model nobody explains to you. Here is something your bank will never tell you directly. Your bank is not your financial partner. Your bank is a business, and like every business, its primary obligation is to its shareholders, not to you. The way a bank makes money is fundamentally simple. They take the money you deposit, lend it out to other people at a higher interest rate, and keep the difference. Right now, the average savings account in the United States pays somewhere around 0.5% interest annually. Some of the big national banks pay even less than that. Chase, Bank of America, Wells Fargo, their standard savings accounts often pay as little as 0.01%. Let me translate that into real numbers. If you have $10,000 in a standard savings account at 0.01% interest, you will earn $1 over the entire year. $1. Meanwhile, that same bank is lending your money to someone else at 6, 8, 12, 20% interest. They are earning hundreds of dollars on your $10,000 while paying you $1 for the privilege of using it. This is not illegal. It is not even hidden. It is simply how banking works. But here's the question that should be bothering you right now. If inflation is running at 3 to 4% per year, meaning prices go up 3 to 4%, and your money is earning 0.01% in a savings account, your money is not standing still. It is losing purchasing power every single day it sits there. The $10,000 you deposited last year can buy less today than it could when you deposited it. Not because your balance went down, but because what $10,000 can purchase went down while your balance barely moved. This is the first way the bank quietly makes you poorer. Not by taking your money directly, by creating conditions where your money loses value while appearing to be safe. Section 2. The fee machine. Now let us talk about the fees, because this is where the extraction becomes impossible to ignore once you see it clearly.
The average American pays somewhere between $200 and $400 per year in bank fees, overdraft fees, monthly maintenance fees, ATM fees, wire transfer fees, minimum balance fees, paper statement fees. Each one feels small in isolation. A $35 overdraft fee here, a $15 monthly maintenance fee there, a $3 ATM fee because the right ATM was not convenient at that moment. But add them up over a year, over 5 years, over 20 years of a working life. The average person who starts paying bank fees at 22 and continues through retirement pays somewhere between $4,000 and $8,000 in bank fees over their lifetime. And here is the number that should make you stop the video and sit with it for a moment. $4,000 invested at 22 into a broad market index fund, earning 10% annually, becomes over $70,000 by age 62. Not $4,000, $70,000. That is what the bank fees are actually costing you. Not the $35 for the overdraft, $70,000 in compounded wealth that you never built, because that money went to the bank instead of into your future. And the people who pay the most in fees are not the wealthy clients. They are the people with lower balances, less financial flexibility, and fewer options. The banks extract the most from the people who can afford it the least. This is not an accident. Section 3. The debt trap that is disguised as convenience. I need you to pay close attention to this section, because this is where the system becomes genuinely predatory. The average American carries approximately $6,000 in credit card debt. That number is not dramatic sounding until you understand what it actually means in practice. The average credit card interest rate in the United States right now is somewhere around 20 to 24% annually. On $6,000 of debt at 22% interest, making only the minimum payment, you will spend approximately 17 years paying that debt off. Not 6 months, not a year, 17 years. And by the time you finish, you will have paid over $13,000 in total, more than double the original balance. $7,000 in interest on $6,000 of purchases. $7,000 that bought you nothing, that produced no experience, no memory, no value. It simply transferred from your future to a bank's present. And here is the thing that makes this so insidious. The credit card was marketed to you as a convenience, a safety net, a rewards program, a tool to build credit. Those things are technically true, in very specific conditions that most people never actually meet. The condition is pay the balance in full every single month without exception. The moment you carry a balance, even once, even a small one, the interest charges begin, and the rewards you earned are almost always less than the interest you are paying.
The bank wins, you lose. And the bank designed the product knowing this. The rewards program exists to encourage spending. The minimum payment exists to extend the debt. The introductory 0% rate exists to get you in the door before the real rate kicks in. None of this is hidden. It is in the contract you signed, in language that requires a law degree to fully parse. Section 4. The loan system and who it is actually designed for. Let me show you something about how loans work that will permanently change how you see borrowing. When you take out a mortgage, a car loan, or a personal loan, the bank uses a repayment structure called amortization. Amortization means that in the early years of your loan, the vast majority of your monthly payment goes toward interest, not toward reducing your actual balance. Here's what that looks like in real life. Imagine you take out a 30-year mortgage for $300,000 at a 6% interest rate. Your monthly payment is approximately $1,800. In your very first payment, over $1,500 of that $1,800 goes to interest. Less than $300 reduces your actual balance. You just paid $1,800 to your bank and your debt went down by less than $300. In year 5, after 60 payments totaling over $100,000, your remaining balance is still approximately $275,000. You paid $100,000 and your balance dropped by $25,000. The bank collected $75,000 in interest in just the first 5 years. Over the full 30 years of that mortgage, you will pay approximately $348,000 in interest on top of the $300,000 you borrowed. You will pay $648,000 for a $300,000 house. Now, I am not saying do not buy a house. I am not saying mortgages are evil. I am saying understand what you are signing. Understand the full cost. Understand that the bank has structured this loan to collect the maximum amount of interest from you in the years when you are least likely to pay it off early. Because if you pay it off early, if you make extra principal payments, the bank loses years of interest income. The loan is designed to be difficult to exit early and expensive to carry long. Section 5. The wealth gap the bank creates and who benefits. Here is the insight that I promised you would come in the final part of this video. Everything I have described, the low savings rates, the fees, the credit card interest, the front-loaded mortgage structure, these are not random features. They form a system, and the system has a consistent directionality. Money flows from people with lower balances toward the bank, from people with less financial flexibility toward the institution with complete financial flexibility. But here's what happens on the other side of the wealth line. For clients with significant assets, typically those with $100,000 or more in deposits, banks behave completely differently. Fees are waived automatically.
Interest rates on savings accounts are negotiated. Loan terms are more favorable. Personal bankers are assigned. Products that are not available to standard customers become available. The system that extracts money from people with less is the same system that competes to serve people with more. And the gap between those two experiences is not fixed. It is not a permanent condition you were born into. It is a threshold. And the path to crossing it is understanding the system clearly enough to stop feeding it and start using it differently. The people who build real financial security are not the ones who earn more than everyone else. They are the ones who understood early that every dollar paid in unnecessary bank fees, in credit card interest, in minimum payments on revolving debt is a dollar that will never compound for them. They moved their savings to high-yield accounts that actually keep pace with inflation. They automated debt payoff to eliminate interest costs as quickly as possible. They used credit cards as payment tools, paying in full every month, rather than as borrowing tools. They learned to read the products the bank was offering and ask one question: who does this actually benefit? And when the honest answer was the bank, they chose differently. I want to leave you with this. Banks are not going away, and this video is not an argument for putting cash under your mattress. The point is simpler than that. You are operating inside a financial system every single day. That system has rules, and the people who designed those rules designed them to benefit the institution first. Understanding those rules does not make you cynical. It makes you informed. And being informed means you can make choices that put your money to work for you instead of for them. Move your emergency fund to a high-yield savings account today, not next month. Know the interest rate on every debt you carry. Know it exactly. Pay your credit card in full every month, not minimum payments, full balance. And start treating every dollar that leaves your hands as a decision, not just a transaction. Because the person who understands this and acts on it is playing a completely different financial game than everyone around them. Drop a comment right now. Tell me one thing about your bank that you are going to change after watching this. I want to read every single one, because the awareness in this comment section is exactly the kind of conversation that shifts financial outcomes. And if this opened your eyes to something you were not seeing before, share it with one person who needs to hear it. Because the most expensive thing in most people's lives is the financial system they are inside of without understanding it. Subscribe if you want more of this, because this channel exists to show you exactly how money moves and how to make sure more of it moves toward you. See you next week.